Hello and welcome to the latest episode of Zach's Tech Talk Tuesday. My name is Ryan McQueenie and earnings season is officially here. So we're going to celebrate that this week. This week's not really owned by the tech companies. We had the big banks kick things off last Friday, and then this first week or so is really primarily financials. Bank of America on Monday, and that seems to just kind of leak throughout the rest of the week. The bulk of the names there are going to be from that sector. However, I think some of the bigger, most important, most market moving names are coming from the technology sector this week. And we're going to highlight those, briefly talk about expectations for the sector as a whole, and then highlight a few of those marquee tech reports coming out over the next few days. I just want to note that our overall Zach's consensus estimates have earnings in the technology sector expected to be nearly 15% higher than the previous year on 11.4% higher revenue. Those are down a little bit in terms of the growth we've seen recently, but still one of, I think 13 or 11 of our 16 sector groups that are expected to see double-digit earnings growth. Again, number of reasons for earnings growth, in terms of market-wide tailwinds. Obviously, the tax cuts have been a huge earnings growth catalyst for a lot of companies, but just overall strength of the economy, consumer spending, and capital investment from enterprises has really helped a lot of companies grow both the top and bottom line. To me, 11.4% higher revenue is the bigger story there because you do have that tax cut buoying earnings growth. The fact that you're seeing 11.4% revenue growth really, to me, underscores how strong business conditions are for many of these technology companies. I do want to note also, before we jump into specific reports, that since things are going to be getting busy over here in the next few weeks, we'll be talking about a bunch of reports. We'll miss some, certainly, as well. Just simply don't have the time or capacity to cover every single key report on this show. But one way that you can keep up with this, and I'll make sure to throw a link in the accompanying article, is by using the Zach's earnings calendar. It helps you plan out all your reports, give you a week-by-week calendar, but it's also a one-stop shop to properly prepare with the key facts and times for earnings reports, the results after they come out, broken up day by day, dividend announcements, and other important financial releases. It's a super handy tool as things get very busy here in the next few weeks. Just gives you a quick one week view. Click on what day you want. You got everything right there. And again, link if you're listening to this via Apple Music or Spotify, definitely check out the accompanying article on Zax.com, and there will be a link to the Zax earnings calendar there. Although if you're already on Zax.com, it's right up at the top under earnings, so you can find it there as well. So the big key question here now, especially in the wake of last week's sell-off and Friday's slight rebound that was kind of shaky. It was a nice healthy rebound, but kind of uncertain at times. On Monday, we were in the red again, so things looking still a little bit rocky after the extreme volatility that we saw last week. And I guess the point of bringing that up is that now with earnings season here, we've got the bulls very hopeful for Wall Street to be able to overlook a number of these headwinds that we're talking about and kind of focus on what we hope are strong earnings results this season. So something in terms of market-wide strength in these reports that can inspire us to forget about these rising bond yields, inflation concerns, U.S.-China trade dispute, all those headwinds we're talking about could potentially be outweighed or overlooked if the earnings results are strong enough. The last couple of report cycles, it seems like we've talked about strong reports already being baked into stock prices. And with that big sell-off just ahead of the bulk of the reports, I don't know if that's normally necessarily the case now. Everything's kind of off the 52-week highs, off those all-time highs, and maybe that gives stocks a little bit of room to a little bit of room to run higher if the reports are good. But you could frame it the exact opposite way and say this just put us on alert, and this just meant the reports are going to have to be even stronger, or we're just going to exacerbate the selling here. Either way, getting back to my original point, I think the stakes here are really high for tech, and we'll start to see that this week with 3 or so major marquee tech reports. It's 3 that I want to highlight today. We're going to start with today's biggest report. Video streaming behemoth Netflix, of course, scheduled to release its latest quarterly earnings report after the market closes today. It's Tuesday, October 16th. For those who might be joining us late, if you tuned in Wednesday, the report's already out, so you can go back and look at those results already. But anyway, Netflix is always the first of the FANGs to report, so this is important for a number of reasons, not just to kind of gauge the strength of Netflix's business and the strength of this video streaming market as a whole, but also to set the tone for the FANGs, and all the pressures that come with being these market leading tech stocks. Netflix itself releases relatively decent guidance, especially in terms of the subscriber growth it is expecting to see. Netflix said that it expects to add 650,000 subscribers in the US and about 4.4 million internationally in this quarter that is about to be reported. This would bring its subscriber total to 135.14 million. That's just, to me, a staggering number. I remember when we did a special episode about Netflix getting over that 100 million threshold. It just keeps on climbing. We also look to our own non-financial metrics estimates in times like these. We've used these on the show before. You guys know the deal. It's consensus estimates compiled very similarly to how the Zacks consensus estimates for earnings and revenue are compiled, trying to get a consensus read on what Wall Street analysts are thinking for these line items like subscriber growth. Interestingly enough, our NFM estimates are actually both slightly higher for U.S. and international subscriber growth than Netflix's own guidance, to the tune of 669.5 thousand domestic subscribers and 4.4 million international subscribers. Netflix, I was rounding up with Netflix's own guidance, 4.35 million on the international side of what they're looking for. So the analysts seem bullish according to our NFM estimates, and then looking for tons of growth on both the top and bottom line in terms of the Zacks consensus estimates for earnings and revenue. Adjusted earnings expected to be 68 cents per share. Revenue expected to be 3.99 billion. That's growth of 134.5% and 33.7% respectively. Yeah, that earnings growth is crazy, triple digits, but that's still 34% revenue growth for Netflix. Again, a really amazing growth story for the video streaming giant. In terms of most recent analyst sentiment, looking back to last week, in the wake of the sell-off, Citigroup analysts upgrading Netflix from neutral to buy, saying that sell-off was, quote, an opportunity to own a high-quality recurring revenue franchise with attractive upside potential. $375 per share price target for Netflix, slapped on there by Citi in that bullish note. And that's a 17% upside from the stock's Thursday close, post sell-off close. High stakes for Netflix. As always, we have high expectations for this company. I will say it's been kind of weird. It's kind of been difficult to get your finger on what Netflix is going to do, because for years and years and years and years, it was always going to beat earnings estimates. Now it seems a little bit more focused on the margin expansion, which oftentimes does result in positive news for the earnings side of things, but not always beating earnings numbers now. And I'll say this much, doesn't really matter, because typically investors are still trading this on whether it's beating the subscriber estimates or not. So you can almost guarantee that's going to be the thing we all react to tomorrow, or today, I should say, unless there's some sort of shocking beat one way or the other on the top or bottom line. Then maybe that will snag some headlines. But typically it is that subscriber figure that this thing trades on in the wake of earnings. That said, a company that could always use a positive earnings surprise and revenue surprise these days is enterprise computing behemoth IBM, also slated to join the mix this afternoon, October 16th again. IBM has finally started to consistently grow its revenue over the past few quarters. Can't remember how many back it was, but just a few quarters ago, snapping that ugly streak of revenue declines. Although as consistent as that has been, as nice as that has been to see that rebound and that streak kind of reverse itself, we're still talking about the same types of things. Some of its traditional core products kind of phasing out, and then trying to find growth in this cloud computing market, which is extremely competitive. So look for those to be either headwinds or tailwinds again in this report. Last quarter surprised positively, which was a good sign. However, there was a kind of some skepticism surrounding the surprise because of how much it was accounted for by a new sales cycle for an outdated server technology. So investors kind of showed this desire to want to see the growth in the key future-minded categories like the cloud computing. If you're going to beat because you performed very well over in this kind of server business, it was a specific branch of the server business that was kind of getting phased out, but they were doing a new sales cycle for it. It performed very well. Wall Street wasn't super pumped about that just because, it's not what the future holds for IBM. Either way, earnings estimates for IBM have actually come down in the past 60 days. We are all about the earnings estimates and the earnings estimate revisions over here at Zacks Investment Research. It's what makes up the Zacks rank. So that negative trend has earned the stock a Zacks rank number 4 sell ahead of its report. Consensus estimate now sits at $3.40 per share for earnings. That would be up 3% year over year. And then the Zacks consensus estimate for revenue is at $19.10 billion, which actually represent just a teensy little dip, 0.3% decline year over year, which means if it wants to keep that newfound revenue growth momentum up, it is gonna have to surprise to the upside. IBM to me just doesn't have the same clout that it once had, but this thing is still a powerhouse in the tech sector. We might not talk about it, might not trend on stock twits, every day, but $19 billion in revenue a quarter, certainly something we look to define trends and to see where spending is in the tech sector and whether those things are robust or not. So that would be another reason to hope for a revenue surprise tomorrow. Is if IBM's doing well, its clients are doing well, and that's a good sign for really everybody. Wrapping things up here, I did want to talk third and final earnings report I wanted to talk about today is digital and mobile payments giant PayPal, expected out on October 18th after the market closes. Had a strong 2018 going until last month, and then the stock began a correction. It's now tumbled nearly 20% from its 52-week highs. That's that correction, bear market territory we always talk about. It's probably healthy. I don't think it's the end of the world for PayPal by any measure, especially since this is one that I think attracts a lot of buy and holders anyway. But we are looking for good things from PayPal again this quarter. Been plenty of positive estimate revisions for upcoming fiscal periods, especially, which has lifted the stock to a Zacks rank number 1 strong buy in recent weeks. But for the soon-to-be reported quarter, earnings and revenue are expected to be 54 cents per share and $3.7 billion, respectively. That would be growth of 17.4% and 13.2%. So that is earnings and revenue growth slightly outpacing what we want to see from the rest of the technology sector on average. So, you're still talking about above average, above market average earnings and revenue growth metrics that kind of by definition still PayPal's in this growth stock category, not the crazy rates maybe it has seen in the past, but this has been a really consistent performer since the spinoff from eBay several years ago now. And I think that the expectations will be high. But again, we're getting this for the first quarter in a while. You're going into a report with the stock trending significantly down. So, there's two sides of that coin. Does that mean uh, a less than stellar report exacerbates selling, or does that give the stock a little bit of reprieve and a lot more room to run higher on good results? We'll see in the coming days. That's again PayPal, IBM, Netflix, and plenty more in the upcoming weeks. We will do our best to cover the ones that you need to know. Fair warning, we're going to certainly miss some, but if you want us to cover specific earnings report in these next few weeks, if you feel that I missed something today, or if you want me to talk about something else, definitely remember you can email me at podcast@zax.com. Please say what's up. Love to build that rapport with the listeners. Also, make sure to check out all of our other exclusive audio content at zax.com/podcast. Remember to subscribe and leave us a rating on Apple Podcasts. It really helps the show. We're also available on Spotify, Stitcher, SoundCloud, basically anywhere you can find a podcast. We are there. That's going to do it for us today. Thank you so much for listening to the Zax Tech Talk Tuesday. We'll see you next time.